$2.28, trading up 0.055 cents or 2.48% in the intraday session so far. You're looking at a ticker that has likely burned more retail investors than almost any other name in the clean energy sector over the last 5 years. Yet here we are, watching Plug Power claw its way back above the $2.20 mark on significant volume. If you are holding shares or watching from the sidelines, the expectation right now is likely one of fatigue. You expect this bounce to fade, you expect the cash burn to continue dominating the narrative, and you probably believe that the hydrogen dream is effectively on hold until interest rates collapse completely. That is the consensus view. It is safe, it is pessimistic, and it is largely based on the trauma of the last 24 months. But the reality digging underneath today's price action suggests something entirely different is happening behind the curtain. We are seeing a structural shift in how capital is interacting with this company. We are moving away from the speculative frenzy that drove this stock to irrational highs years ago and entering a phase of heavy industrial execution. The market is pricing Plug Power not as a tech growth stock anymore, but as a distressed infrastructure play that is finally securing the government backing it needs to survive. The tension here is palpable. The market expects a bankruptcy narrative or a dilution death spiral, but the reality is that the Department of Energy loan guarantee and the tightening of the cash conversion cycle are creating a floor that very few people are paying attention to. While everyone is looking for the next Nvidia stock or trying to chase the momentum in Tesla stock, the smart money is quietly calculating the liquidation value versus the going concern value of Plug's physical plants in Georgia and Tennessee, and they are realizing the math has changed. Let's look at the tape right now. Trading is active, and we are seeing a consistent bid at the $2.25 level, which acts as a psychological support today. This is not just retail traders on a Robinhood app throwing lunch money at a meme. This is institutional volume defending a level. When you see this kind of price stabilization after a prolonged downtrend, it often signals a transfer of inventory from weak hands, those who bought the hype and sold the despair, to strong hands who are accumulating for the next 3 to 5 year cycle. The price of $2.28 might seem insignificant if your cost basis is $20, but in the world of distressed assets, a hold above $2 validates the market cap enough to keep institutional mandates from selling out completely. We need to address the elephant in the room immediately. Cash flow. The primary bear case for Plug Power has always been that they spend dollars to make dimes. For a long time, that was true. However, the recent quarterly data is showing the first real signs of what management calls Project Quantum Leap, a dedicated effort to slash operating costs and improve margin profiles. Expectation was that cash burn would remain over $300 million per quarter indefinitely. The reality is that we are seeing that burn rate compress. It is not vanishing, and we are not profitable yet, but the trajectory has shifted. When you invest online or use tools like Schwab Intelligent Portfolios to screen for deep value, you often filter out companies with negative margins, but the algorithm misses the inflection point. The inflection point is when the rate of loss slows down significantly while revenue continues to scale. That is where Plug sits today. Consider the broader context of the energy markets. We are seeing a rotation. For the last year, the entire market has been obsessed with AI and data centers, names like Nvidia stock and the supporting semiconductor ecosystem. But those data centers require massive amounts of power, and the grid is tapped out. This is where the narrative for hydrogen returns with a vengeance, not as a car fuel, but as stationary backup power and grid stabilization. Plug Power's fuel cell business is uniquely positioned to serve this niche. If you use Fidelity Investments or check the research tabs on your Fidelity trading platform, you will see a growing category of reports analyzing off-grid power solutions for hyperscalers. Plug is right in the crosshairs of that demand. Let's talk about the Department of Energy. The $1.66 billion loan guarantee is the singular catalyst that changes the liquidity profile of this company. The expectation was that this money would never arrive or come with strings so tight it would strangle the company. The reality is that this capital acts as a seal of approval from the U.S. government, effectively designating Plug Power as too strategic to fail in the context of the National Hydrogen Roadmap. It lowers their cost of capital significantly. When you are building massive hydrogen generation plants, your cost of capital is everything. If you can borrow at government-backed rates versus distressed market rates, your entire unit economics model flips from red to green. This is something you won't see clearly just by looking at a line chart on your SoFi active investing dashboard. You have to read the credit agreements. Now, I want you to take a second and engage with this idea. Comment below how many shares of Plug Power you currently hold and what your average cost basis is. Are you averaging down at these levels, or are you waiting for a clear breakout above $3? I want to see the sentiment in the comment section, because retail sentiment often leads price action in these high beta names. Moving deeper into the mechanics of the stock's recent movement, we have to discuss the short interest. Plug Power has historically been a heavily shorted stock. When a company with high short interest starts to stabilize and secure financing, you create a powder keg scenario. We are seeing borrowing costs for shorting Plug shares fluctuate, and any positive news catalyst, like a definitive announcement on the next tranche of DOE funding or a new major partnership with a logistics giant, could trigger a squeeze. This isn't the same dynamics as a massive cap like Apple stock, where liquidity is infinite. In these mid-cap industrial names, a rush to cover can send the stock up 20 or 30% in a single session. We saw a glimpse of this volatility recently, and today's 2.48% move up is just a tremor compared to what happens if the shorts are forced to cover en masse. Let's strip away the stock price for a moment and talk about the business itself. What are you actually buying at $2.28? You are buying a vertically integrated hydrogen company. Most competitors, like Fuel Cell Energy or Bloom Energy, focus on specific parts of the stack. Plug tries to do it all. They build the electrolyzers that make the hydrogen, they build the liquefaction plants to transport it, and they build the fuel cells that consume it. Historically, this was a capital-intensive nightmare. It meant they were bleeding cash on all fronts. However, as their plants in Georgia and Tennessee come online and hit nameplate capacity, they stop buying hydrogen from third parties. This is critical. For years, Plug was buying hydrogen at market rates and selling it to customers like Amazon and Walmart at a loss just to honor contracts. That dynamic is ending. They are now producing their own molecules. The expectation is that margins are permanently broken. The reality is that vertical integration is finally starting to work as the physical infrastructure comes online. If you are using interactive brokers trading or analyzing the order flow, you might notice that the bid-ask spreads on Plug options have been tightening. This suggests that market makers are pricing in less extreme volatility in the downward direction. The bankruptcy put is being priced out. Investors who manage their own portfolios, perhaps through self-investing strategies or via a generic individual brokerage account, often miss these subtle signals in the derivatives market. When the puts get cheaper and the calls see higher open interest, the market is quietly betting on a recovery. We also need to look at the macro environment. Interest rates. This stock is extremely sensitive to the Federal Reserve. When rates are high, financing a billion-dollar hydrogen plant is expensive. As we move into an environment where rate cuts are on the table or already beginning, the discounted cash flow models for Plug Power improve drastically. It's simple math. A 1% drop in rates increases the present value of their future projects by a massive margin. This is why you see Plug Power often moving in sympathy with the Russell 2000 or other small-cap indices rather than just moving with energy stocks. It's a duration asset. Comparing this to other popular retail holdings, you see a divergence. Stocks like Robinhood Trading Stock or SoFi stocks have their own drivers, mainly user growth and fintech adoption. Plug is a pure hardware and commodity play. It is building things in the real world. This is harder, slower, and more expensive than writing software, but it also builds a moat. You can't just code a hydrogen plant into existence. The barrier to entry here is enormous. Once Plug has these plants running, it's very difficult for a startup to come in and displace them. They have the first mover advantage in the liquid green hydrogen market in North America. Let's discuss the institutional landscape. Who owns this stock? It's not just the speculative growth funds anymore. We are seeing passive flows from major indexes and ETFs. If you look at Fidelity ETFs or Vanguard funds, they are forced buyers as long as Plug maintains its index weighting. This provides a natural bid. However, the active managers, the ones who run hedge funds and proprietary desks, are watching the gross margin line item like hawks. The moment Plug prints a quarter with positive gross margins, the re-rating could be violent. The street doesn't believe they can do it. That is the expectation. If reality proves that they can, the stock doesn't stay at $2.28. Think about the ecosystem of online investing. Platforms like SoFi Invest and Robinhood Crypto have democratized access, but they